We recently published our 2026 Market and Economic Outlook, Gifts of Fruit and Flowers. The title compares equity markets to a wedding anniversary, as in 2026 we expect a fourth consecutive year of market gains. 2025 was a good year for global equity investors. Gains were led internationally in both developed and emerging markets, but the US was strong as well, as the S&P 500 index delivered its third consecutive year of double-digit percentage returns, with an increase of 16.4% on a price basis and 17.9% including dividends. It was nearly a year ago, but the first quarter of 2025 was down nearly 5% at quarter end due to tariff and trade uncertainty, and it got worse in April. From late February to early April, the index suffered a peak-to-trough decline of 18.9%. But soon, tariff threats led to trade deals, and Congress passed an early July budget bill, and the market rallied to new highs. Ultimately, we attributed strength in U.S. equity markets to U.S. economic growth that exceeded expectations and strong corporate earnings. Consumer spending trends were healthy, and business investment surged as technology spending on artificial intelligence and data centers hit multi-year highs. In our view, potential market catalysts outweigh headwinds in 2026 and can support modest S&P 500 gains for the year. But risks remain as well, including a softer jobs market, lingering inflation, elevated valuations, and geopolitical uncertainty. I'll briefly discuss the components of our 2026 outlook. First, our S&P 500 fair value estimate is 7,100, with an upside range to 7,500. We see rotating sector leadership, but the tech trade is not over. U.S. economic growth can move above 2%. We see more Fed rate cuts ahead, and of course we expect volatility, and it is a midterm election year. Our S&P 500 7,100 fair value estimate is about 4% above year-end levels, and along with dividends suggests a total return close to 5%. This is lower than S&P 500 gains over the past few years, but it's in line with our view that investors should scale back return expectations. But if economic and earnings trends exceed expectations, we have an upside range of 7,500, leading to a total return above 10%. We also caution that along the way, volatility is likely and market pullbacks should be expected. The S&P 500's valuation on a price to earnings, or PE basis, which takes the current index price divided by earnings estimates per share over the next 4 quarters, is 22.1 times, approaching a 10-year high. The PE's recent peak was 23 times in late October, but it's pulled back a bit recently. We don't expect the broad S&P 500 PE to expand from current levels, with gains ahead relying on earnings growth. And in 2025, just 3 sectors delivered price returns above the broad S&P 500 index. Communication services and technology benefited from technology and AI investment, and industrials likely benefited from positive trade developments and economic optimism. Although the strongest returns were concentrated to those few sectors for the full year, 10 of the 11 sectors were positive, and during the year we saw periods of leadership from other sectors: industrials, financials, utilities, and healthcare. As we have done in recent quarters, we ask the question, should investors continue betting on growth, or are there opportunities in other areas? And again, we conclude a little bit of both. We argue that stocks that can sustain higher earnings growth should trade at higher valuations. And if we look at the PE to growth rate that allows us to compare an adjusted valuation for a high growth sector versus a low growth sector, looking at the 2025 PE divided by the estimated annual earnings growth over 3 years, the S&P 500 PEG ratio was about 1.8 times at year end. And there were 5 sectors that traded at a PE to growth ratio lower than the overall index. And those were technology, financials, communication services, materials, and healthcare. And we measure U.S. economic data from the Commerce Department Gross Domestic Product, or GDP report. The U.S. economy accelerated in 2025 after a weak first quarter, growing more than 3% annualized in the second quarter and over 4% annualized in the third quarter. The fourth quarter may have slowed due to the government shutdown, but recent reported data from Q4 has been better than expected. While we follow 4 major components of GDP: consumer spending, business investment, housing investment, and government expenditures, we note that the combined consumer spending and business investment comprise about 84% of GDP, and we like to isolate those 2 categories to measure what we call the private economy. In 2025, those two categories improved successively from Q1 to Q2 and from Q2 to Q3. Business investment in red was identified as a contributor to GDP growth upside, but consumer spending growth accelerated even more. And looking ahead, both consumer and business investment trends appear healthy, and productivity helped by AI investment can help to boost economic growth. The Federal Reserve Bank, or Fed, manages very short-term interest rates by setting a target range for the Fed funds, which are overnight rates used for bank lending. The Fed funds rate can influence short-term rates in the economy, but has less influence on longer-term interest rates, say at 5 to 10 years. Since September 2024, 15 months ago, the Fed lowered its Fed funds target 6 times for a total of 175 basis points, including 75 basis points of cuts in 2025. The current Fed funds level at the midpoint of the range is 3.62%. Comparatively, the yield on the U.S. government's 2-year Treasury is market traded, and over the past 4 years has fairly accurately predicted future interest rate moves by the Fed. The current 2-year yield is 3.48%, which for now suggests one more rate cut over the next few months. By the end of 2026, though, we think the Fed funds target could be at a range of 3% to 3.25%. One factor that could slow the pace of rate cuts is consumer inflation, which we get from the BLS Monthly Consumer Price Index, which tracks prices on a basket of goods and services. CPI was 3% in January 2025, and in December ended the year at 2.7%, showing progress, but still above the Fed's 2% target. There's been concern that tariffs would add to inflation trends, especially for goods, but that has not happened to a measurable degree. Inflation can trend lower in our view, but it's unlikely to meet the 2% target in 2026. Our market outlook for 2026 is positive, although it reflects moderation from 2025. And keep in mind that the S&P 500 suffered that severe decline during 2025 and then rallied. Markets are likely to encounter periods of uncertainty and negative sentiment in 2026 as well. Geopolitics remain volatile, with Venezuela uncertainty now added to Israel, Gaza, and Ukraine-Russia pressures. President Trump still uses tariff threats as a negotiating tool and has recently lobbed policy threats at a handful of targeted industries, an indication that smooth sailing is unlikely. It's also a midterm election year, which will be contentious and likely lead to some change in control of Congress. Midterm election years, which are year 2 of each presidential term, have been the weakest year of all president terms since 1969. And in the 14 previous year 2s, the average S&P 500 return was less than 1%, and half the years were negative and half positive. This is a warning to expect some volatility. But our response is to stay the course, remain diversified, and use volatility to rebalance portfolios. And the good news is that year 2s are followed by year 3s, which have averaged 16.9% annual gain and positive 93% of the time, only one down year out of 14. For specific recommendations and strategies, please contact your D.A. Davidson Financial Professional.